Hi guys, welcome back to the channel. My name is Dave, and today we're talking about selling in the money call options. So typically the natural way is to sell out of the money. But today we're going to twist it around a little bit. We're going to see if we can take a little risk off the table, maybe just a little bit of profit. But in the right scenario, this is a great strategy. So if that's something you're interested in, please stick around. Whoop! Okay, I would say the natural way of selling covered calls, the way that everybody gets started when it comes to options, because it makes the most sense, is a person goes out, for example, and they buy stock XYZ at $100 per share. They buy 100 shares, and they turn around and they immediately sell the covered call at 103, right? So their goal here is to collect some premium, maybe $100, plus those $3 of stock appreciation by the time this thing gets called away. Now, the stock can move up or down. Who knows what's going to happen? But that tends to be the typical strategy. Now, it's very unnatural to do it the way we're going to talk about today, but there are times when I definitely would say this is the way to go. And a lot of people prefer it this way. But if you're not used to it, you don't work through the numbers, and you don't take a good look at your basis, it might not make sense. So that's what we want to talk through today. And in this situation, we're going to take stock XYZ, buy it at 100, and turn around and immediately sell it at maybe $97 call option. So we'll talk through the whole idea. The idea is we're going to take off some risk, and at the same time, we might lose a little profit potential. But in the long run, I think this is a great strategy to use. Now, if you've been watching some of my other videos, you know my typical strategy is the wheel strategy, where I like to sell a put, right? So it might, if a stock XYZ is at 100, I might sell the $97 put and wait for it to put to me. And you might say, isn't that kind of the same thing? And in some ways it is, because it offers some of that same protection, because the stock has to drop, right? But when you're doing this and you buy the stock in the first place, you own that stock. So if there's an ex-dividend date, that kind of thing, then you own and control those shares from that moment. So with all that said, today I want to walk through an example, and I also want to discuss option delta, one of our first Greeks that we should know about. And I'll show you a trade that I made this week too that I think worked out pretty well. Well, we still have to see if it works out pretty well, but I like the position that I'm in. All right, so before we start talking about option delta, let's talk about how this typically plays out. Let's talk about stock XYZ at $100 a share, and you can buy it right now, and you can turn around and you could sell the covered call at 103 like we discussed, collect your premium, and see what happens. But in that case, let's say your premium is going to be $100. But if you decide that you're going to sell like the $97 call, aren't you going to lose money, Dave? Isn't this crazy? Why would you do that? Well, no, because when you sell out 4 weeks on the same one that you're going to purchase, because we'll go look at this as an example, but when you sell this $97 covered call, you're going to be able to collect the $3 of built-in intrinsic value that was already there. So in this case, it's at 97 and the stock's at 100. You're going to be able to sell that option for $300 plus the existing extrinsic value, the implied volatility and the time that's still involved in that. So let's say you might get $375, whereas if you sold the other one at 103, maybe you get $100. So it's going to be a little bit more money. But by reducing this number, now the stock has to drop all the way down to 97 in order for you to keep it, right? And if it drops to 97, you're going to be able to turn around and do exactly the same thing and sell another covered call. The one thing you got to do is make sure you keep track of your basis so that you're not actually losing out on this trade. But in general, you're going to give up a little bit of money, but your entry point is going to be dropped all the way down. So at 103, you're going to collect a premium of essentially, let's say $100 as an example. Whereas at 97, you're going to collect a premium of $375, which makes up for the $300 of basis. That's going to lower that. Plus you get the $75 an option premium that's in addition to that. So that's our starting point. So it offers a little bit of protection on the downside. So to prove this out and illustrate a little bit better, let's look at an option chain on Fidelity for Apple. I pick Apple because it's not going to have a big difference between your bid and your ask. And if you do this with something that doesn't trade a lot of volume, well, then you're going to see those big swings in bid and ask price, and it might not make sense. So Apple will be our example. All right, so this is the option chain for Apple as of the close of 10/29/21, basically on the weekend. And Apple closed right around 150. So at the money is 150, right? So if we look at our option chain here and we focus on the call side, I want to talk a little bit about delta first. So what is delta and how does it relate to all these other numbers that are on the screen, right? So today we'll just do a kind of a general, get a general understanding of it. We can go into more depth, but if you have questions on it, just ask down below. There are two good ways to think about delta, our option Greek here. One is that for every dollar that the underlying stock changes, that the value of the option will change by that much. So at the money, since Apple's right around 150, it's going to, if Apple goes up by $1, the option value will go up by 50 cents. If it goes down by $1, it's going to go down by 50 cents. And it's important that you understand that we're talking about the call side. And over here, so on this side, it's going to range from 0 to 1, okay? And over here on the put side, it's going to go from 0 to -1. It's always done based on the position of looking as a buyer, okay? So think of it that way, and it should kind of play out for you. And as you go farther and farther away from this, it's going to get closer to 1 on one side and closer to 0 on the other side. One of the ways I like to think of it is at the extremes. So right at the money, it's going to be 50 cents. But if I was to go way up here, way to the top, and I was a buyer in this case, and I was going to say, okay, Apple's at 150, I want to buy the $200 call option. Well, it's basically saying that, wow, it has no delta value. It doesn't matter that you're doing it because your probability, your option to actually make anything on that is virtually 0. So that's a good way to think about it, right? Whereas if you buy something that's really, really deep in the money, way up here, right? And where I'm talking about like the $100 call option, you go out and you buy that sucker, well, that delta value is going to be 1. And what that truly means is that every time the stock moves 1 point, the option value is going to move 1 point, right? So it's going to mirror it. So whatever the stock does, the option value does the exact same thing. The other way people like to look at delta values is by thinking of it as a probability that the option will expire in the money. Okay, so if you look at something again, that $100 call option, it's going to be a 1. It's going to be virtually impossible. It's going to expire in the money in some form, right? Whereas the $200 call option that would be way down here has virtually no chance of expiring in the money. Even this $170 call option, if you were to buy it, it has only about a 4% chance in theory or expectation. Okay, so I want to stress expected. It's expected to be 4%. And this one's expected to be 72% of the time. So Apple's at 150. I would expect it to be in the money in 4 weeks from now, 72% of the time is what delta is telling you. And for us, if we're going to buy and sell a covered call, if we're going to be a seller of a covered call, then we can use this delta value to say, okay, 72% of the time, we would expect this thing to get called away from us. Whereas if we're going to buy that at 150 and sell out 4 weeks for the 170 call, we'd expect that to only get called away from us about 4% of the time. So if you have questions on that, that's what it means, but you can ask me down below and we can go into more depth at a future date. But start looking at those delta values and start associating those with these strike prices. And I bring all this up because when we're doing these types of trades, we want to start thinking about getting high delta values into our trades. The higher the delta value for selling a covered call, all right, when we're looking at selling an in-the-money covered call, means it's more likely to get called away for us, but it also means we're offering ourselves more and more security that it's going to be a trade that puts money in our pocket as long as the numbers make sense based on our basis that we paid for it in the stock. And we'll go into more depth here on that right now. All right, so let's talk this trade a little bit. Let's say we decide to go out and we buy 100 shares of Apple at $150 a share on a Monday morning. And we turn around and do our typical scenario of selling the $155 call. If you slide over here, you're going to see that your premium is going to be about $1.40. So you're going to put $140 in your pocket and you're going to go have your sushi dinner, right? Whereas another option would be to slide down here and sell the $145 call, right? And you might be thinking, well, that's crazy because look how far in the money that is. Oh my gosh, why would I do that? Well, let's slide over here and see if it makes any sense, because what you're going to be able to collect for this one is about $600. Okay, so 140 versus 600. Now you have to account for your basis. So you paid 150 for it, and it's at, you're selling the call at 145, basically saying, hey, you can call it away from me at $145 a share. So we have to account for our basis. So that's $5 of basis, basically, or $500. Take that away. So essentially, our net here is $100. okay? So here we make $100, and here we make $140. Make sense? So you're giving up a little bit, like I said. But you're getting some protection. So let's talk through two different scenarios. One, the stock goes to the moon. In that case, this is a no-brainer. This is the way you want it to be, right? You buy it at 150. 4 weeks ago, we'll buy, and it closes at 160. You get to keep all of your premium you collected, the $140, plus you made $500 on the stock appreciating in value. Whereas in this case, that same case here, you're just going to have that $100 that you made. It gets called away, and you put your $100 in your pocket. So was that a successful trade? It still was, but obviously making more than 6 times that in the other scenario is much better, right? So this is an opportunistic situation. So now let's talk through, oh my gosh, earnings come out, Apple, no good, it drops a bunch. So let's say it goes to 144 after earnings, and by this 28 days has passed, it drops all the way to 144. So now, if you're looking at that, now you collected your $140 here, right, on this $155 call. But now you're way out of position because you're at $144 and you've basically lost $600 in stock value, right? So this now doesn't look so hot, right? Because you got to scramble around and decide, can I get much premium if I start selling the 150 call, right? So it depends on the situation and how you feel about that stock. Whereas if you want to be a little bit more cautious and you go and you do that scenario where you do the $145 call and it drops all the way to 144, well, now you get to keep all that $600. So you're basically paying this off and you're lowering your basis to 145 plus that extra $100 that you got thrown in there. So your basis is truly 144, which is exactly what the stock price is now. So now you own Apple at 144. Or you could say you own Apple at 145 and you got an extra $100 for your sushi dinner, however you want to think about it. And you're going to be able to turn around and sell that $145 call again, feeling really confident in that trade. So those are two different scenarios, and it just depends on the situation, because is there an ex-dividend date coming up? Do you want to own this? Do you want to buy it right now, offer yourself some protection and try to capture that and the dividend? That's usually the scenario that I see. But either way, you have to decide which way is best for you. So this trade tends to happen two ways. One is just like I just showed you with that Apple example, where you create the trade because you like the return. The other one happens very naturally if you sell lots of options, and that is, right, stock gets put to you at 100. Let's say it's that stock XYZ again. Or you just buy the 100 shares and then you sell the covered call, right? So either way, you're at $100 and you sell the $103 covered call now. And it's out 4 weeks. And after 1 week, it goes to 103. After 2 weeks, it goes to 105. Then after 3 weeks, it goes all the way to 110. So now you look at your option value, right? You originally got $100 for it. And now it's got $7 of intrinsic value. Plus, it still has some extrinsic value. So you might look and say, oh my gosh, it's $750 now to close this out. I don't want to do that. Now, you've done pretty well in the trade, right? You made $100 and it went from 100 to 103. So you could just let it lie, get called away, and do just fine. But this is where I get a little greedy and I look out and I say, is there opportunity here to roll this out further? Because it's a pretty secure trade at this point. It has to drop $7 just for me to get it, called away, or for me to keep it in this case. So I look out and I say, if I close this and it's going to cost me $750, and you want to make sure you track your basis, right? How much you have in the stock. But if I close that out for $750, can I open it again out 4 weeks from now for $800? It's only $50, but it's very secure $50, which I like. Maybe it only represents a 4, 5, 6% annualized return. But if I'm trading out across the next dividend date out 4 weeks, I really feel like I'm putting the pressure on the other side, right? Because in this scenario, I might be able to collect that dividend, which might turn this 5% into 20% or 18%, something really nice, annualized. Or maybe they want that dividend and they're going to call it away. But in that case, instead of having it for 4 weeks, maybe I only have it for 2 weeks, and I get to, I get to shorten that up. So my return instead of being 5, 6% becomes 12%. So that's what I'm looking at. And that's why you should be looking at these opportunities. And those are the two ways that this naturally happens, or you create this opportunity. All right. So now I want to show you an example of a trade just like this that I did this week using Intel. Now, every time earnings come out, Intel just gets clobbered. It's a good value stock, though, one that I like to buy after earnings. And I like to sell puts against it, sell covered calls. I like to accumulate a little bit and hopefully ride it up. So that's kind of the setup right now. The ex-dividend date is coming up next week as well. So that's the setup. I don't know how this thing's going to turn out yet, so we'll have to wait and find out. But let me show you the position that I'm in now. All right, so let's take a quick look at the Intel chart. This was a 2-year chart. I've added earnings, E's, and D's for dividends, and this is a moving average here too, 20-day moving average. But the thing that cracks me up with Intel is every time earnings come out, as I mentioned, earnings come out and it drops. Earnings come out, and right after earnings, they pay their dividend. That's their ex-dividend date. So, this is one that I like to trade consistently. Mark it on your calendar. You have earnings, big drop, dividend, recovery. Earnings, big drop, dividend, recovery. I'm not a big pattern guy, but come on. Earnings, dividend, a little bit of recovery. And it just repeats. So now we just had earnings again, big drop, dividend's going to get paid, and I hope for recovery. All right, so here's how I approach this trade. I'm always looking for as many successful avenues as possible. So when I see opportunity like this, I jump on it. And I already own Intel, so I'm not looking to add necessarily to the position unless I can do it at the right price. So I went out and I purchased 400 shares, and I immediately turned around and I sold the call on 10/28. So I bought it at $48, just over 48, and I sold the $47 call with an 11/19 expiration. So I'm going to hold this for a little over 3 weeks, right? And the idea here is that I'm a little bit in the money, only 2.2% below the stock price where I purchased it at, right? Just $1 below. But because it's $1 below, I collected a big fat premium, $585.30, which sounds amazing, right? But we have to adjust for our basis. So that's where I say basis adjustment, right? We got to make sure we keep track of that. So I bought it for 48. I'm selling it for 47 times 400. So I have to adjust for $430 outside of that premium. So that gives me a net premium of about $155.30 that I'm going to put in my pocket and go have my sushi dinner that I love so much. Okay, so that's the scenario, that's the setup. So if we look at what my real basis is, we can calculate that, right? Because it's $48 per share times 400, so a little over $19,000 that I've got in my basis. And if I look at that, if I utilize that to calculate an annual return based on the fact that I'm going to hold it for 25 days, and there's 365 days in a year, right? And there's my premium that I collected after adjusting for my basis, then I get about 11.8% return. So nothing crazy, but a nice little return that's somewhat protected. Now, the ex-dividend date for this is 11/4, so just a week away. And for that, I'm going to get 35 cents per share or $140, okay? So since my expiration is out a few weeks, I have no doubt that I'm going to get to collect that dividend. So if you add in the dividend to that 11.8%, we're going to get an annual return of 22.4%. So now it's looking a little bit better. I'm pretty excited. And if for some reason, prior to the dividend being paid, if I get early assignment, well, then it would make it a 42% return. So I threw that in there. I doubt that will happen, but it can sometimes happen, but I doubt it in this case. But threw it up there just so you could see what that would look like as well. So I feel like in this case, I'm pretty well protected. And if for some reason the downside, worst downside, right, if it falls to like $46 a share, then I'm going to keep this and I'm going to buy it at $47 a share, and I'm going to hang on to it for a little while because I like Intel at 47. So that rounds out this being a successful trade. If I can own Intel at $47 a share, great. If it doesn't get down that far and I just keep this and get my return of 22.4%, great. I'm all happy. So I'm looking forward to this. I think it's going to work out well. I'd like you to ask any questions. If you don't like it or you think I'm crazy, let me know. All right, so there you have it. One more strategy you can stick in your back pocket for when the opportunity presents itself. Now, if you have any questions on this, please ask down below or shoot me an email, and we'll talk to you real soon. Thanks so much for watching. Have a great night. Whoop!